Get going, Brandon. See, I just
You
wanted to
should.
say that. I wanted to say that twice. I want to have the bad moon rising, and then there's a bad moon on the rise. So, good morning, everybody. I hope it's a good morning. It's been an interesting week, and it's not like last week.
Hey, Blake, what's changed in the past week? Everything.
Nothing. Oh wait,
Nothing.
everything.
Everything. I don't know. I just feel like, look, I mean, this is not your father's sell-off, right? This is an entirely new deal.
Well, we've got this list, and I started just typing it up that we talked about, and I even left off stuff because my font started getting smaller and smaller and smaller and smaller, and so I cut up a number of things. Like, I mean, it was your idea and your proposal. It said, but what's really changed? And I kept thinking of David Spade, but really, and we have. It seems though we have this grasp, this attempt to hang on to the well, it's like it was last time. Now, I know the maxim that the most dangerous four words of a trader are this time it's different, but it is.
Well, that's the thing, right? I'm like, people frequently say, "Well, I'm a technician. I watch the chart." Well, charts have broken, right? I'm like, like I'm not gonna, they just don't want to. Like, there's a tendency to just want to go back to what worked previously, and that works when things are moving along, right? When the Fed's accommodative, and when the wheels are greased. Well, the Fed is looking to accommodate by lowering rates, but this time we're doing it from a position of weakness, not strength. And so it's like when you see the Fed begin to cut, that's generally the time you want to sell. And we're looking at rate cuts starting to be priced in. And so things have really changed in the last week.
Well, we've marked up just a few of these things, and I think we can or we need to go kind of beginning to end on a lot of this. Maybe those of you that are watching, do you see something that's different, something that you've been able to rely on and trust on? Say, well, every time it does this, I can just do this. What is it that you've relied on, all of our live watchers and listeners? What have you relied on to say I can always do this on a pullback, on a dip, besides the simple buy the dip? Besides that one
Yeah.
certainly didn't work very many times this last week, except for yesterday. But what is it that you've relied on? Because this is more fundamentals and some technicals that Brandon and I use. And we're going to start out with Brandon's fixed income junk versus treasury, but we'll also be going through some earning surprises, the bulls and bears again, and we'll try to get to some of your questions and some of your stocks that you want to look at. But we're going to come back here and look at the real change, starting with this fixed income junk and treasury. So Brandon, this is something you pay attention to, and maybe give some color to this. What
Yeah.
is the HYG versus IEI?
So when you look at treasuries, right, government bonds are considered risk-free. I know you may debate that, but that's generally considered risk-free. So if you have the government borrowing here, well, where are companies borrowing? Well, guess what? The spread between what the government borrows at and what corporations are borrowing at is historically tight. And so for the last while, I've been waiting for this spread to blow out. And so what happened over the last week on the jobs data after the Fed raised last week, with the Bank of Japan raising rates, the unwind of the carry trade, all of a sudden we started to see a huge bid in treasuries as treasury prices went up. And it's a teeter totter. As treasury prices go up, yields go down. Well, at the same time, borrowing costs for your very uncreditworthy companies, your junk bonds, those yields went up dramatically. And so all of us are pretty decently. So all of a sudden we saw borrowing costs for companies go up as borrowing costs for the government go down. And all of a sudden you have this kind of blowout or breakout in the junk bond yields to treasury yields spread. And that's a sign of caution, of risk that's being priced in that hasn't been priced in now for a while. And so that breakdown in the red line is showing that government bonds have significantly outperformed junk bonds over the course of the last little bit over a week. And that is a sign that there's a risk being priced into the corporate bond market. Rising corporate borrowing costs mean what? Lower earnings. And we saw a lot of companies borrow money, significant amounts of money in 2020, 21. And if all of a sudden we're starting to price in that risk, they're going to have to borrow at significantly higher yields. And as a function, it's going to impact earnings going forward. So this breakdown is
I
fairly
was just gonna, I
significant.
just flipped it over and just, just maybe if you want to see, this is telling you that you get paid, or, you get paid much better or get charged a lot more to borrow, and seeing that spike there. It depends on which way you want to see it. If you're trying to think of it from the bonds versus, or the junk versus the other,
Well,
the
yeah, you got to look
standard
at
is,
it from a longer perspective. But yeah, but like the
yeah,
idea is that the borrowing costs, we started to see a big drop. This is a pretty significant decline. Now we got to bring it to the left scale. Yeah,
yeah,
we're
yeah.
looking
And
at the
I
left
was going to flip
axis.
it. Yeah. And I was going to, I just thought, you want to think of it the way that you can think of it as far as returns, you can think of it as far as borrowing costs. And so if you're just simply investing in it, you have a much lower return on the one, but you have a lot higher cost on the other side. So it
Yeah,
depends on
so
which
just
side
saying,
you're a borrower or a lender.
yeah. So when that line drops, so I usually I do it this way to kind of reflect market conditions. So generally speaking, when high yield sells off relative to treasuries, it's bearish for the market. Red line's going down. And it also means generally this is not, we're talking about, an area that's correlated to high yield credit is REITs. We've yet to see the breakdown of REITs yet, but this is a sign that borrowing costs are going to go up for these companies, or likely relative to what treasuries are paying. That's a problem, right? That's a bearish indication.
Yeah. And the other thing is, when this is doing this, and the reason why I flipped it for just a minute is because, again, you're talking about investments, you're talking about that drop, but when it spikes the opposite direction, that means that small businesses, even if rates come down, can they borrow at lower rates?
Yeah.
They can't. They gets widened out, and so it costs them more anytime they go out to even if they drop rates a little bit,
Yeah.
they can't borrow. The money's
Right.
not there.
Yeah. I mean, if you look at the treasuries, what happened with like TNX, for example, I mean, and HYG is probably close to like a 2 year duration, 2.5 year duration. But the idea is that we saw a lot of bond buying in treasuries. We saw selling in HYG. Don put on a long put vertical out of the money, looking at that 73 level on HYG. Again, expect to see more follow through to the downside here. We kind of snap back. This is the it, right? Is this the bear market rally, or is this the bottom of the market? Well, if this is a bear market rally, probably expecting HYDG to roll over. And I know Dom is targeting kind of the lower end of this 1 year range, close to 73. But really, with that spread, it only needs to get to like 75, and you're pretty decently profitable.
Yeah. Well, and I do think that this will feed into more than just high yield bonds. It's going to feed
Yeah,
into more than TNX. So in the TNX and the bounce that you just saw there, TNX, I hate that CGI thing. I will
I know.
never like it. TNX CGI, even this bounce, you can see we have reversed off of that. So you see this
Yeah.
big old bounce through here, the downtrend, we're pricing lower and lower and lower rates. We bounced all the way up here, and then we flopped back over here. And so this to me does not seem, again, very promising. And remember, the reason why people are speculating that we're going to cut rates is because the economy is slowing.
Yeah.
This is not good news.
This is not just about inflation, maybe, and we'll find out more about inflation next week, but this isn't exclusively about inflation, the rate of inflation cooling off a little bit. This is about real growth concerns. This began in part following the jobs number. We're finally seeing that good news is bad news is bad news. And with the 10-year at 3.9%, all of a sudden we're starting to price in rate cuts. Well, now we're talking about the uninversion of the yield curve potentially by the end of the year.
Well, that's my question is, will it? If we cut short-term rates, is that going to drive that flat? Is it going to be able to turn it back at the opposite direction?
Yeah.
And so, I don't see it. It seems like to me that we're going to cut rates and still stay inverted, and we're just going to see it all shift down, because we already saw the long-term shift down too. Everything is just going to keep that inversion and to go down.
So now what you're describing is an even more aggressive action on the part of the Fed. Because if that's what happens, the entire curve shifts down. Right now, the 10 years at 3.9%. We're looking at a 50 basis point cut, 50-50 out, a little bit better than 50-50 odds of a 50 basis point cut in September. If you go to December, was closer to 1%. So we're looking at a 5.25 to 4.5%, 70+% chance was a 1% cut by December, the end of the year. Well, all of a sudden we take it down to 4.25 to 4.5%. The 30 year, 10 years around 3.9% right now. If the 10 year shifts lower, the Fed's trying to uninvert it, right? They're going to continue to cut rates until they get that because they're trying to boost the economy, boost lending. And that just means more aggressive action on the part of the Fed if they're not getting the response that they want. And that means the yield curve uninverting to help support banks. But if they're not getting that, that means we're even more dire trouble because we're continuing to price in a lack of growth and inflation.
And I just bring this one up really quick. This is the daily
Yeah.
treasury rates. You're right from treasury.gov. And, usually we talk inversions with the 2 years and the 10 years. And, it's not as bad as we might expect, but this is the real issue is that the absolute shortest term, people are not incentivized at all to lend in long term. And you can't really borrow in those types of markets. And so we have a 5.42, 5.55. So we are super inverted here. And you'll see it just keeps on going and going and going. And then we kind of turn the angle at 10, 20 and 30. But that is bad news. We're seeing that we're still 1.55% difference from a 1 month to a 10-year.
And the Fed
And
hasn't
that's
cut
a lot
rates
of
yet,
correction.
so the short end of the curve is not going to move. But if we're looking at a 1% cut by December's meeting, now we're looking at that short end dropping by 1%. What happens 10 and 30? We might start to see a flat, maybe start to invert, especially if inflation starts to pick up or expectations pick up. But that's what the Fed wants. The Fed wants to kind of uninvert this thing, help bank profitability, help their margins, because they are a bank, a private bank, right?
Yeah. Well, and
But we're
I
looking
thought
at
this was
huge cuts
scary.
by next year, right?
Yeah.
Upwards
So
of
September 25, we're talking about that we're 50-50, that we're going to be all the way down to 3.25.
yeah,
There's your 2 points. Two
right.
whole
So
points. That's 8 cuts that are being priced in by September.
and again, that's different than a month ago, right? That's different
Yeah.
than any selling we saw in May or
It
even in
doesn't show us that,
March.
but yes.
We're now pricing in significant rate cuts on the part of the Fed, and again, it's being corroborated by what? By news, right? By earnings, by earnings, by jobs. So the Somme rule triggered, right? In terms of unemployment rate ticking up off the lows. I mean, lots of things are happening. If we see a pickup in unemployment, you're typically entering recession. If the Fed's cutting rates, we're typically entering recession as the yield curve uninverts. So the odds of a recession next year are pretty high. If we're not in a recession already, we don't know.
Yeah.
They'll tell
Well,
us later.
and I showed this yesterday. I mean, how can you say this is anything but a trend? I mean, we can do
Right.
technical analysis on the weekly unemployment claims. For those of you that are not aware, this is not the net, it is new. This is just new unemployment filings. People that had employment and now are filing for their benefits. And this is absolutely an uptrend. I don't care that it went down a little bit from last week and came in lower than the anticipation. I care that this entire trend bottomed out here and has been climbing, making higher highs, higher lows, taking out the highs from all the way back in middle of 2023. This is an uptrend. And so we are seeing a change in the employment situation. So when we talk about the changes, these are long-term changes and continuing to rise. So
yeah, and so the backdrop of this, we have the yen carry trade, which has been very supportive for technology stocks. That unwind is happening. We've talked about this before in our sessions. I mean, Blake's a currency guru. But look, and we've had a significant breakdown in strength in the yen, which says what? That cheap money that's been flowing from Japan into the United States, helping to fuel the trade in technology, Nvidia, that's coming off, and it's not likely coming back soon.
yeah, yeah, and that's even if it did come back soon. I mean, I wouldn't be betting against even a technical view over 151 because you shifted this. Even if they raise rates and they stop, you've now changed the fundamental core of literally free money.
Yeah.
And it's just not, you shifted it or you shifted the angles one way or the other. So either the total trend is altered or the angle is altered. And so don't expect this again, maybe in your lifetime.
And this may be just the beginning of the unwind and the strength in the yen as the amount of available yen is coming in. And look, I mean, the corresponding risk off scenario, we're seeing it in the VIX spiking to 65-ish. I mean, that's a big deal. I mean, you don't have these events occur, but very infrequently. And generally it accompanies Fed rate cuts. I mean, Goolsby saying, oh, if it deteriorates further, we may step in. I'm like, we're going to fix this. The reality is the Fed will push on a string right now, right? If they start to
Mhm.
aggressively cut, inflation is likely going to pick up quickly. And even if it doesn't, it's just a sign of weakness that they can't create any sort of uptick in inflation.
Well, and it's interesting to me that, they're supposed to have mandates apparently, and the mandates are to do what?
Create inflation.
And create inflation to pay off our debt. And that's true. I think you're saying that tongue in cheek, but you know that it's true as well as I do. Their job is to manage inflation, but manage it in a way that we can forever spend money.
Right.
And as they spend that money and they manage that inflation situation, they're supposed to get that inflation, the jobs to a certain level. Well, I believe they've given up completely on getting it to that 2% rate, and that mandate and their behavior and their changes and shifts in the market, they've gone from managing an economy and the free open market committee, the Federal Open Market Committee, supposedly doing it in that open market, hasn't been in the open market in how long? And so this is direct manipulation, but now they're manipulating and working the stock market, because that's all. Since
Right.
when were they supposed to be invested in the stock market? Since when were they supposed to be responding to a pullback in
Right.
equities as an indication that where is that? Where in all the Fed reports does it say equity performance?
Yeah. Well, and that's the
And
thing is
now
we're
they're
trying to
reacting to
create
it.
this wealth effect, but the problem is like again, the wealth effect that the Fed is interested in creating is a wealth gap. And so, and again, you may be participating in this. And for the most part, we see this massive spike in the VIX. We haven't seen that big sell off yet, right? We were down
Mhm.
maybe upwards of 10%, a little bit less than 10% peak to trough in the S&P. We haven't really seen panic set in the equity side of the market, maybe with some issues and in people with leverage. Obviously, this hurt them hard, big time, this pullback here in the market. But for those that have managed risk, this has not been a great deal. This is a pretty nice little pullback if you're selling premium, you're able to buy back calls, for example. But this would indicate panics ensuing in the market. But the reality is, we're not down that much right now.
Yeah, as far as the big picture, the broad market, and even if we're really, get a perspective. Let's use the SPX so we can actually get something that's a very long-term perspective. When we're looking at the moves in a panic type of a sell, I'm gonna leave it on weekly just because I remember when this was horrendous.
Yeah.
And then we take this into perspective and say, this and this is nothing. And compared to this. Now, if we're down a little bit off the top, if you've been invested in the markets, if you had your 401ks, if you are all those things that wealth effect that you're talking about, this pullback here is nothing in relationship to the big picture. If you are in the market for a long time, if you're 65 plus or 59 and a half plus, if you're talking about tax rates, when you're looking at that, this pullback doesn't impact the wealth and growth that you've recovered on and returned back to break even on from 2013. We'll say 2013. From there, 2013, we've gone from 1434 to 5750. You've increased whatever you added to it, but you theoretically have increased, if you're tracking the broad market, you've increased by 2.5 times. And so as we're looking at that and pushing up to these record highs, this pullback is nothing. If we're going to talk about it as a component of what we saw in erasing, say this, got my alarm going off, 6 years was lost in a year. If we lost 6 years as a perspective and a correlated move, we're talking a move to cut it all the way back here. And even then, you're still double what you were from 2013.
Mhm.
And so
In
that
nominal
is,
terms.
yeah, phenomenal rate, nominal rates of return. Yeah, assuming that you don't leverage up on the way as it falls, you're leveraging up on for bullish on the way up. So I see this as, yeah, it's a little scary for some. Short-term traders are going to be surprised. Long-term traders are going to wonder where a bunch of their money went. But this is still a massive, massive super bear cycle uptrend when we look at the big picture. But in this move here, the question is, did it change enough that we are headed back to wipe out this year? Just this year.
Yeah. So there's a lot. I mean, so my point is just that there's potentially a lot more work to be done to the downside. I'm like, you don't see a 65 VIX very often, that you don't see probably closer to a, or above 50, above 38. You don't get those values without seeing a much bigger pullback in the market. So that's where I think you just got to be a little cautious right now. I think there's maybe opportunities popping up, but the reality is we may see follow through to the downside. The VIX may only go to 30 or 35 maybe, but there's potentially maybe, another 10% downside from here that's lining up. And so again, I think you got to be a little cautious right now that because the risk, the daily moves, the VIX is double what it was in July. You're taking about twice the risk right now to really get long, depending on the types of stocks you're investing in. Obviously, if you're investing in lower beta stocks, the risk may not be as high.
And beta stocks, for those that maybe are newer, is just simply how closely correlated does it move in as far as ratio wise to the underlying or to the S&P. So if the S&P moves up $1 or 1%, and your stock moves up 1%, you have a beta of 1. If you're talking high beta, it means you're leveraged up and it moves all over the place and has a lot of volatility. So when the VIX has its volatility spike like this, your stocks are doing this and they're just going all over the board.
Yeah.
So
L.A. Dung mentions that we're talking about nominal versus real. He says, I agree, but taking into account inflation, not so much, right? So that's the thing is, I'm like, inflation, Fed fueled inflation. If you look at the S&P in gold terms, we really haven't gained since like late 90s. So, I mean, we're kind of treading water. Recently, we've had a little bit of an uptick here, but yeah, it's definitely in real terms, we're not performing as well as what it looks like on the chart. But again, this is a point right now. It's like, you protect yourself, to the downside.
And I don't mean to I'm not trying to throw any shade on Jimmy Carter, because he is an amazing human. But
no, he's an amazing peanut farmer.
Yeah, peanut farmer. But it's like the saying Bloody Mary, you summon her, and she appears in the mirror or whatever. If we say Jimmy Carter, do we pull in stagflation? I mean, because it is kind of like, I'm using the word stagflation, and are we seeing the same kind of thing? Because we've seen, like you said, massive amounts of inflation comparatively, and so the growth really isn't there. Their nominal just isn't there. Taking into consideration inflation, it's the old adage, are you better off today than you were 5 years ago, 1 year ago, 10 years ago? So if you're part of this market, are you better off than you were in October of last year? That's it. Just start with that. If you didn't benefit from this, but did your pocketbook get squeezed by the inflation that drove that? I would say probably it did. Maybe it did, but I'd say probably.
It's rough, man. Like, although, the $5 value meal at McDonald's is helping things.
Well, so let's just use that as a very sloppy segue into into some of the performing stocks. Maybe you got earnings
Sloppy Joes.
Sloppy Joes. I was thinking of going right into your performance on some of the individual stocks and the earnings surprises. We had pizza, Papa John's. When we're talking about McDonald's, McDonald's has normally been one of my ones that ties into consumer staples and rotation, meaning substitution. When we can't afford going out to Texas Longhorn Steakhouse, we go over to McDonald's. But when it's a $5 value menu, but then they said, oh, well, I guess we were just gouging you. Silly us. And they said, and so let's give you a little bit of a value menu. And suddenly they bounce.
Yeah.
That's telling you something. That tells you that they were, not only was inflation there, corporate America was gouging you. Why do you think you had those earnings shoot to the moon? It wasn't that they had inflation, they just passed it on to us. They said had inflation and saw an opportunity. Oh, well, if inflation is up 10%, let's raise our prices 20. So as we're looking at pizza, tell me about pizza. What happened here?
UK Ray's asking, why do we talk about processed food in America? Because we work so much. Right? We're just looking about hours worked, right? So, but anyway, it's on every corner, but so this is kind of a similar type potential reversal and trend like McDonald's, right? The earnings from pizza wasn't amazing. We saw year-over-year growth. They did beat estimates. We're seeing year-over-year, they're actually in decline. But one of the things that they're improving on is margins. So we get this coincidence in terms of their operations are doing a little bit better. We're seeing a deep kind of valuation here in terms of again, not deep, but it's trading at a much better value than its peers. And you kind of see this consolidation phase over the last month, a break of that 45 area. Let's just say yesterday's high. We get some volume. We got good volume yesterday. We just faded. But if we break through that, we're basically looking on PZZA a bit of a reversal, maybe towards like that 52 range. If you draw a fib on the downtrend going back to January,
You
maybe
can
you're
have a
making
fib.
back a third of the loss. And so I think this is one, it's just starting in January. But
Oh,
anyway, but the
just
point
January.
is,
Okay.
like, you might get, you might make back about a third of that downtrend just on the idea that earnings may improve, which may get you that 54, 56 area. Now you don't have to change it. It's okay. That's about where we're at,
I
about
just
54 to 56. So again, this
you
isn't some
fib.
sort of long-term opportunity potentially. It could develop into that. But I'm just kind of really looking at the possibility if we break 45 on better margins and a comparatively good valuation, that may have a chance to get us at 54, 56 area in PZZA. And there was some bullish option activity yesterday in as well.
Well, and Domino's was such a high performer. I mean, I've jumped this over to up over here. They both sold off aggressively through there,
Yeah.
which is interesting to me because I mean, Domino's just had a year. I mean, they outperformed
Domino's
Apple. They
Domino's
outperformed
pizza
Apple.
stinks.
I don't care.
I'm
I
like,
don't. I have not eaten at McDonald's since my youngest was 8 years old, which is 13 years ago.
yeah.
And so, um, so I don't care if you like them or don't like them. I just stock's the stock, right?
But
You can hate Domino's pizza all you
yeah.
want. It's okay. I give you
So you're kind
permission.
of seeing just in this case a divergence in price and also the earnings response. So bullish earnings response to pizza yesterday, bearish earnings response to Domino's. So I'm expecting
Yep.
these to kind of come in a little bit. In this
A little
case,
bit of
Domino's may go lower, pizza going higher.
yeah, and they unless Domino's starts cutting margin or reducing costs and improving margins too, but there's only so far Domino's can change quality to cut their margins.
Yeah, when they changed their sausage, I was like, "What the heck's going on? This is weird. I don't even. It doesn't even taste right."
Yeah, well, they substituted instead of making pizza dough, they just got more pizza boxes and just cut out circles and
Yeah, seriously,
put it on
they
top of
call
there.
it thin crust.
Thin crust, thin crust. It's our old boxes that we couldn't use. So let's take a couple other looks at some of these earnings surprises and some of bulls and bears. We've got just a few minutes, so let me go back to my list and let's pick our favorites here of what we might be interested in highlighting because I want to get to some of yours that you are interested in looking at. I'm just going to high level again. Nothing has changed for me as far as utilities. I have not backed away from buy stinking utilities for the last, what, 6 weeks, 7 weeks,
Yeah.
8 weeks. But I did put in Caterpillar because I think Caterpillar is a really interesting bounce there. And you have, let's go over here.
Don
You're
was wearing
looking
his
at some,
Caterpillar shirt yesterday.
oh, was he? There's a good sign. And part of the reason is because even in the sell-off, it wasn't as dramatic, and we filled the gap and we closed through the gap yesterday. And we reacted to earnings. We came back all the way back. That gap was pre-earnings, and so the earnings were able to push it up high enough, and we filled the gap. So I think it satisfied the pullback. And I am looking for a Caterpillar to get back up to 362. And it may not look like much to go from here to here, but that's a 10% recovery.
Yeah.
And from current price, let alone from the low. So I
And
do
on a
like
dividend
Caterpillar as
payer,
far
I
as
mean,
a bounce.
that's, you get a 10% move. Like, you take the dividend, buy a put even if you want. I'm like, just,
Yeah. And I never would have considered myself a big dividend stock player, but all I've been doing is utilities and big dividend players.
yeah.
I think it's a great place to go as far as safety and setups there. You were looking at GIS.
Yeah. So Kellogg's had a nice earnings response. I mean, obviously GIS already had its earnings, but the idea is that Kellogg's a pretty expensive company. General Mills is not. And these have phenomenal margins too. I mean, but again, they pay dividends. I think it's 3.5% on GIS. I forget now.
I can pull that up.
Trying to put it on my end. I'm like, I can't even do it. Yeah, 3.5% yield.
3.5%.
Right. So again, it's just one of those things like you have a low beta stock, pays a good dividend, especially if the Fed's going to cut rates. Yes, we've been range bound. Yes, we're towards the upper end. But if you back this out to a longer term chart, there's definite room to the upside. Again, if the earnings continue to support that. But again, you start to take out 72, we start to maybe we're going to go to 82 from there. So I think there's reasonable amount of upside from a longer term breakout standpoint. They're getting a good yield right now, 3.5%, especially if the Fed's going to go to 3% by next year, 3.25. You're right there in terms of yield and price and valuation.
Yeah, I think it looks good. Now, we both talked a little bit about real estate rallying off of this, the idea of we're going to cut rates in the future, but both of us, we always just share each other's symbols that we're looking at. Both of us end up with some real estate stocks. Now, mine are a little bit of fundamentals, Datadog and Equix. I think this is an opportunity to fade into this strength on this recovery. That doesn't look like much, but I'm looking at this from a fundamental perspective. If we really are seeing some weakness in tech sector and in the data centers, and we don't, this looks like a 3-year chart, and so it looks like, oh, we're just kind of consolidated here in the middle. But on the daily chart, I'm looking for it to fail. This is such a strong barrier for Equinix that I do think we can come all the way back down to the lows. And if we're not seeing the money move into the tech sector, they're not going to be expanding. They will spend less. They will cut costs as well. And one of the fastest ways they'll cut costs is where they're storing their cloud. The cloud is up above you, see, and it's just so your stuff goes.
Oh man.
Oh, I'm not supposed to do that. Okay.
Not on your computer. It's in the
it's not in your computer
I didn't know
anymore.
what
It's in the
type of
cloud,
cloud
you
it
know?
was, but
It's above you. It's a cloud.
yeah.
It's above you. You also got AGNC.
Yeah. So, here, look, I mean, this company is based on what? It's based on mortgage REITs. So all of a sudden, if the Fed cuts rates, their existing portfolio at higher yields look better, right? But in the end, borrowing costs may be set to rise for the REIT space. These are heavily leveraged companies. And so all of a sudden, if we're starting to see that breakout in high yield, generally speaking, these companies do poorly. And if we start to see a fall off, we start to see a rise in defaults, all that stuff starts to come together with an economic slowing, higher borrowing costs. So again, I'm looking for AGNC to break here. If we take out that 950 area, we could see a much bigger decline in the stock, but even short term, a pullback towards $9 seems pretty reasonable.
Yeah, and you can see, even when we're not dealing with an economic squeeze because of what's going on currently, you can go from 10 down to 6.
Sure. These pay really high dividends because they're leveraged. Okay.
Yeah, they're leveraged
10
up.
to 1, 20 to 1, whatever it is. These used to be like 15, 16 to 1. I mean, these are heavily leveraged companies. So they're going to, if you get a cold, they're going to get pneumonia kind of thing.
Yeah. So let's do our last two. And people, if you want to put in a couple of symbols, we'll try to hit a couple. We only have like 4 minutes, but I'm going to throw in Brandon's last one here is Capital One Financial. I like Ally and Capital One Financial as bearish stocks anytime the consumer gets squeezed. But what's your reading here, Brandon?
Yeah, I mean, look, we had the double top relatively quick, right? We've probably hit that near-term projection here, but we're setting up like a flag. So if we start to break to the downside, again, we're looking at that being a relatively sizable seed wave from 130 back to like 154. So all of a sudden you're looking at what, 116-ish to the downside as the next leg lower. So I kind of like this kind of getting back to that 50 to 61% retracement of the trend from October of last year to April as kind of a retracement area. So, but again, near term, we're looking at probably 116 if we break from this flag, fail at the 135 resistance.
All right, that's a lot of downside. That's a lot of risk. I would be definitely careful with that one as well as far as buying into it. And
so
I'm
Floyd's
still
Garage
watching
on YouTube is put in IBB. I mean, what's your take on biotech right now? I mean, again, this is a cyclical part of healthcare, right? It's not a non-cyclical.
Yeah, I think they've been great gambles and bets because people are speculating and they've had a couple of things get approved. But I've told people a lot of times I would love to be more involved in biotech. But I have personally had so much pain from the FDA in dealing with importing, dealing with FDA regulations and trying to stop things on marketing and other things like that. It's hard to know what's going to happen as far as regulation and approval. And so I have a hard time chasing them down. I know from the chart, I think you get your distribution on the IBB where it's you've got it diffused, your risk is diffused. And I do think there's still a lot of upside. But this looks a lot like technology in general.
Yeah.
And so which I have to fade. I just think that gap, the gap, and the struggle here, this is just volatility. This is the fish flopping out of water possibly, and I just think it starts to suffocate and we drop back down into the 130s. And if money is not cheap, research and development doesn't happen. And you don't, I mean, it costs millions just to submit to try to get something new approved. So
we're looking at Lilly yesterday. LLY
yeah,
had a big upside move. But look, I mean, huge guidance. They raised their guidance significantly. They beat top and bottom line. But then you start to realize, wow, this company is trading at 40 times, not this year's earnings, not current year's, not last year, not current. It's trading at 40 times next year's earnings. I'm like, these are priced to perfection. We're looking at AZN, okay, relative better value, but still not cheap. And
yeah.
it doesn't have the growth expectations. So it's like one of those things, where do you find opportunity here that's not pretty grossly overpriced? A lot of it is really overpriced based on massive expectations. AZN's a relatively better company from a valuation standpoint, but it's still probably fairly valued at this price.
Yeah, and I'm sticking with what I've talked about again, utilities, consumer staples, healthcare, but I'd say not just to the biotech. And so don't go into individual biotech, spread out your risk. And I think that's really where you're going to see people moving. And I think that's part of it. You're speculating on the biotech and you're still seeing healthcare as a safety play because money still gets spent there. And even in tough economies, there's still development of drugs and development of apparatuses during those timeframes.
Yeah.
But
So Blake had Nextera, NEE, he had Duke Energy, DUK, and Southern SO.
yeah.
So again, we may be forming kind of a cup and handle formation there in is that Duke or Nextera?
That was the first one was Nextera. Sorry.
Nextera, yeah.
Yeah.
Florida company, decent growth. So you sort of break out that 80, or we're looking at, maybe a 10-point move.
Yeah. And it could be, 12, 15% gain in value. And I know Southern and Duke are highly extended, Dominion too, but they're paying out the dividends. So they don't have to keep going up. They just have to not go down.
Yeah.
And that's going to be seen as a place of safety. I'm not really seeing a lot of symbols. I'm not really seeing a lot of comments in there as far as anyone looking at different things here. And we do need to jump out of the way for Don in about 2 minutes or 1 minute, because he wants to play his music and get things going. Any parting shots, Brandon?
I think this is a point where you got to play it safe, right? So I talked about on Monday the idea that, look, the best way, so back in mid-June, we did an August hedge, an atomic hedge or a variation on it. So the best way to start to get more long on Monday was to roll your hedge. This is a time where if you're going to go directionally long, you're taking more risk because the volatility is higher. Things have changed. And so again, you got to be worried about that another next leg down, because yesterday we finally saw that little squeeze and we finished at the high versus fading. We may have a few more days out of this, but we may see in the coming days here some pretty good setups to get short the market generally. So just be prepared for that.
Yeah, and then things, like Merck and other things, certainly not up near those highs. People aren't betting on them even after earnings. This again looks like the tech sector in general. We're just making lower highs, lower lows, and then a consolidation with big violent swings here in the middle. But there really isn't anything below this low until you get down into the 100s, 104, 102, as far as on Merck as well. So like Brandon's saying, it's the issue or the notice of warning. Be careful here. Just be really careful. Buy the lows, sell the highs. Buy into dividend stocks, buy into safety, things that don't have as much of violent moves. We have stocks that are up near their highs that have 80 and 90% implied volatility percentile, and that's not because of earnings. So there's a lot of uncertainty going on in the market, and it's the market makers are having a tough time pricing it. Don't get greedy thinking that's free money, because it tells us we're probably not done. Greater minds than mine can't price these right now. So. Yeah. All right. Thanks, Brandon. Thank you, everybody. Have a wonderful day, a very successful day, and a fantastic weekend. We'll talk to you again next week for those watching on the TheoTrade Live.
Have a great one.